Mutual insurance companies, owned by their policy owners through participating policies, distribute their divisible surplus to policy owners in the form of policy dividends. Like all funds distributed to life insurance policy owners, policy dividends are available in several optional ways. Dividend basics. Divisible surplus represents funds that exceed the mutual insurer's actual mortality and expense experience for the year. In a practical sense, policy dividends can best be described as a return of unearned premiums. Life insurance premiums are not tax-deductible, so it is only fair that any return of those premiums would be tax-free. Only in rare cases where the policy is deemed a modified endowment contract, MEC, covered in the taxation of life insurance lesson, would dividends be taxable. Policy dividends can never be guaranteed. Insurers may not state or imply with certainty that policy dividends will be paid. Sales illustrations may include projected future dividends, but they must be based on the insurer's current dividend scale and clearly marked as not guaranteed. Dividend options. Participating life insurance policy owners can choose from 5 dividend options. Think, CRAB. Cash payment. Reduce the premium. Accumulated interest. Buy additional paid-up life insurance. Buy 1-year term insurance. Policy owners may change dividend options at any time. Receive dividend in cash. Under the cash dividend option, the policy owner elects to receive the dividend in cash. The insurance company sends a check for the declared dividend on the anniversary date of the policy. Policy dividends received in cash are generally not taxable. Reduce the premium. Under the premium reduction option, the insurance company uses the dividend to reduce the next premium due. For example, if the annual premium was $1,000 and the declared dividend was $250, a policy owner choosing this option would receive a premium notice for $750. Accumulated interest. Under the accumulated interest option, dividends are held in the insurer's general account, where they earn interest. The policy owner can withdraw the accumulated dividends and interest at any time. Note that while policy dividends are generally non-taxable, any interest accrued on dividends left to accumulate with the insurer are taxable as ordinary income in the year earned. Suspend premiums. An option that is available to policy owners who have let their policy dividends accumulated interest is to use the accumulated funds to suspend premium payments. The length of time for which premiums can be suspended depends on the value of the accumulated dividends, plus interest. The larger the account, the longer premiums can be suspended. Buy paid-up additions. Under the paid-up additions option, the dividend buys additional paid-up insurance of the same type as the base policy. The premium rate is based on the insured's attained age at the time of purchase. Upon the insured's death, the total death benefit equals the face amount of the policy plus the face amounts of the paid-up additions. Over time, the cumulative effect of these expanding policy values can greatly enhance the policy's total value, all for the same premium in effect when the policy was issued. Buy 1-year term insurance. With the so-called 5th dividend option, policy dividends are used to purchase 1-year term life insurance. Depending on the specific option selected, the term life face amount may equal the base policy's cash value, or it may equal the full amount that can be purchased with the dividend. If the first option is elected, equal to cash value, also called a combination dividend option, it is likely there will be some leftover dividend. In that case, the unused dividend can be applied to any of the other 4 basic dividend options. Key point. Because the term life face amount consists entirely of pure insurance protection, the 5th dividend option represents a greater risk to the insurer than any other dividend option. If the policy owner requests a change to this option after the policy is issued, the insured will be required to provide evidence of insurability. Paid-up insurance. A less common dividend option, the paid-up insurance option, lets the policy owner use the dividends to pay up the life insurance policy early. Do not confuse this with the paid-up additions option. The purpose of the paid-up insurance option is to pay up the base whole life policy several years early, not purchase additional units of insurance. For your review. Policy dividends are payable only with participating life insurance policies. Participating policy dividends are effectively a return of unearned premium. Dividends can never be guaranteed. There are 5 dividend options: CRAB, cash payment, reduce future premium, accumulated interest, buy paid-up addition, buy 1-year term. While dividends are generally not taxable, the interest earned on dividends held at interest is taxable income in the year credited. Paid-up additions are permanent life insurance policies. As such, they are eligible for dividends and they each have a cash value that grows over time. Please pause the audio and watch the video. You can restart the audio playback at any time.
Insurance policy dividends are sort of like income tax refunds. It's your money that's coming back to you, yet it still feels pretty good when you get it. And that's, if you understand policy dividends, you understand that's really what a policy dividend is. It's a return of, if you will, excess premium called divisible surplus back to the policy owner. Now, this lesson talks about the different ways, the different options available to the policy owner to receive those dividends. And I want to take a moment to talk about one of those options in particular, and that is the paid-up additions dividend option. Personally, I believe that if an owner of a participating whole life policy really understood the paid-up additions option, they wouldn't even consider any of the options, and here's why. With a paid-up additions option, the dividend is used to purchase an admittedly small piece of paid-up life insurance protection. That paid-up policy addition accrues its own cash value. So, for the base premium that the policy owner is paying to own that participating policy, they will actually realize an increasing death benefit as each paid-up addition every year is added to the policy, and the cash value will grow significantly bigger because each paid-up addition generates its own cash value. Let me give you a quick example. This is an annual policy summary of a participating whole life policy, and let me give you the basic facts of this policy. This policy was issued with a $50,000 face amount a number of years ago. The monthly premium for this policy is $61.95. Okay, it is what it is, as they say. But let me tell you, over the intervening years, what this policy has grown to. In addition to the basic policy face amount of $50,000, there is now paid up additional insurance of $23,000, almost $24,000. So for that same $61.95 monthly premium, this policy now has a combined total face amount of almost $75,000. Better yet, the cash value, which is $15,000 for the base policy, also has almost $10,000 of cash value for the paid-up additions. So tying it all together, for that $62 monthly premium, this policy now has a $75,000 total death benefit and almost $25,000 in cash value. If your customer fully understood the power of the paid-up additions option, I don't think that they'd be interested in any of the other options available.
Okay, here's our 4 questions for this lesson regarding life insurance policy dividend options. Which of the following types of life insurance is purchased under the paid-up additions option? I have no idea. I'm going to guess. I got to start paying attention. All right. Which of the types purchased under paid-up option? Maybe a single or maybe premium. All the following statements regarding life insurance policy dividends are correct except one. One is wrong. Dividends are guaranteed is probably not right. Participate include provisions and will choose what you want. That's true. Okay, the interest is taxable. The dividends are income tax free. All right, regarding policy dividend options, the so-called 5th dividend option involves the purchase of 1 equal to the base policy the dividend can purchase. Additional insurance. 1 term. Alright, Gloria chooses to take her life insurance policy dividends in cash. The insurance company sends a check for the amount of the declared dividend on the anniversary date of the policy. What is the tax consequence to Gloria for receiving cash dividends? She probably has to pay tax. Her dividends are fully taxable. Are not income taxable. Gloria is over 59.5. Okay, we'll see. Okay, so the last two we got wrong. Policy dividends are tax-free and age is not a factor. So her dividends are not income taxable. This one here I didn't know. 1 year term life insurance equal to the base policy's cash value or the amount of the dividend they can purchase is the 5th dividend option. Okay? Dividends are not guaranteed. Everything else here is correct. And this one here was a guess also, so I guess I guessed it correctly. Regarding life insurance policy dividend options, which of the following types of life insurance is purchased under the paid up additions option? Okay, so that's it on this one. The next one is life insurance settlement options. So if you're following along in this series, that's the next video to watch. Thanks everybody. Please subscribe.